Welcome to this Killick Explains video. This week I want to take on a pretty technical term, but an increasingly important one for those people who follow stock markets and new companies coming to market and unicorn stocks and all that good stuff. Special purpose acquisition vehicles, oddly shortened to SPAC. Okay, what are they? Why are they in the news? And should you get involved? So the background to this one would be what? Well, basically, these are not new. Okay, they've been around quite some time, but they seem to be making headlines again. 313 of them have been created since 2015, according to Renaissance Capital, who are pretty good at tracking such things, and basically connected big names. So this is what's making the news, if you like. People associated with whatever these things are include famous hedge fund manager Bill Ackman and US House Speaker Paul Ryan, to name but two. So the profile of these things is on the rise. So what are they, and what are the kind of pros and cons? So nuts and bolts, this is the what are they bit, if you like. Basically, a special purpose acquisition vehicle is a listed shell company funded via an IPO by investors such as hedge funds. So it's quite a weird thing. It's just, if you want to see it, a shell company with funding, with money, good to go, that complies with all the listing rules of the market it's listed on, the US stock exchange market that it happens to be listed on. So it's there, ready to pounce. Now the question is, what is it going to pounce on? Well, once funded, it seeks out a target to list. So these are shell companies ready to go, if you like, that have met all of the various regulatory requirements, and what they're looking to do is to grab something which is private and bring it almost straight away listed onto a public market. And then basically the deal is it either finds such a target, and when the SPAC is created, it may not have a specific target in mind, which may sound a bit weird, but it's ready to pounce should the right target come up. If not, usually within 2 years, it returns investors' capital. That might make it sound like a win-win, but I've got 1 or 2 points to be careful of coming up. So an example, if you're wondering, so how does that work exactly? Well, recent example, relatively recent, Diamond Eagle Acquisition Corporation was a US listed SPAC. So in other words, it was one of these shell companies sitting there. I mean, literally all it's really got is a pile of cash or other funding available to it. It bought DraftKings for $3.3 billion in April 2020. All right, that then became the company listed, if you like. Diamond disappeared. The two were essentially folded into each other, and DraftKings became a listed PLC. Now you still might be wondering why you wouldn't just IPO, bring it to market in the normal way, and I cover IPOs in other videos, rather than going down this route. So let's take a look at that in a moment. So what's the point of this route? So set up special purpose vehicle, all right, it hovers, it gobbles something up, they fold into each other, and then you're just left with a company that was private, now listed in a major market. Well, basically, new firms get a listing faster and with less hassle, expense and scrutiny than by a conventional IPO. So imagine you are a large private company, one of these so-called unicorns, billion-dollar valuation, not yet in public hands, looking to go public. That is quite a process. It's lengthy, it's time-consuming, it's expensive, and you are subjected to lots of scrutiny to make sure you meet all the relevant rules and regulations. The SPAC gets a slice of the target's equity very cheaply and levies fees on top. So the people who've set up the shell company, if you like, or if you want to say it, there's a predator, what they've done is shortcut all of that for the company that they're going to snaffle up. So not surprisingly, they reward themselves pretty handsomely for having arranged that shortcut route to market. And the question then arises, well, okay, so we can see what's in it for companies looking to come to market for the first time, sort of ducking round the standard IPO process. We can see what's in it for the team running the special purpose vehicle, a nice dose remuneration, discounted, significant early shareholding, and so on. So what about investors? And obviously, making this video, that's the sort of audience I'm talking about. Now, the upsides, come back to that in just a moment. So the upsides, early access to existing exciting names. So as an investor, in other words, would you buy into one of these things or not? The argument goes, if you want to see the marketing spin, you get early access to some exciting names. Everybody is obsessed with these unicorns, these tech stocks that come out of nowhere seemingly, privately funded, come to the market for the first time. So here is potentially a route in for investors once the shares become available. You've got an option to redeem the shares if you don't like a proposed deal. So it seems like it's quite flexible for investors because they've got several choices. They can fund the special purpose acquisition vehicle, if you like, with an option to get their money back in two circumstances. One, if it takes too long for the vehicle to find a target, or two, if they don't actually like the look of what the special purpose vehicle plans to buy. But, so if you're thinking, well, so far so good, surely as an investor, there are some buts coming up. Now, first of all, what's the success rate of these things? Well, Renaissance, who've got access to some pretty robust data, reckon only 93 out of 313 of these special purpose vehicles have actually taken a firm public. So quite a few of them have sort of arrived on the scene, had a look around, and then folded and vanished again. And the median return, more importantly, doesn't look great so far. Minus 29% since 2015 versus plus 47 for traditional IPOs. So that's not taking this route. That's where a company off its own back goes through all the regulatory hurdles needed to just come to a public market like the London Stock Exchange, New York Stock Exchange, and so on. And the question then becomes why? Why such a gap? Well, essentially, operating costs are pretty high for these special purpose vehicles, and a blank check approach is pretty unusual in investing, all right, and it does carry some risk. And what I mean by that is investors are getting in not knowing quite often what it is that the umbrella company they funded will actually end up buying, and therefore what they will become owners of. So, in short, what is my view? Well, these things are being, it is thought, increasingly angled, steered towards retail investors. So although investors have tended to be institutional, hedge funds so far, it could be coming your way at some point. First of all, this thing breaks several golden rules of investing, particularly for private retail investors. It sounds complicated, and as you know, I don't like things that sound complicated. I prefer to keep things simple, the KISS rule as I call it. These things are expensive. The fees levied by these vehicles before they gobble up and then fold into a target company are substantial, and many people, even having watched this video, still won't fully understand how these things work, which is not your fault, it is a little bit fiddly, and won't see the benefit over buying into a conventional IPO. So basically, you won't know what you don't know, and that makes it quite dangerous, because don't forget, these things don't have to declare what their target is when they list these special purpose vehicles. That comes later. So we're buying into something complicated, expensive, and where ultimately what you're buying into isn't even clear up front. And if that sounds a little shady, well, my view would be that certainly for retail investors, that's a lot of unknowns. So conclusions overall would be what from this one? Well, direct involvement, I would suggest, is not a great idea. All right, as and when it's allowed, as and when the pool of investors is widened. Personally, not a massive fan. People might say to me, well, there's an ETF, isn't there, that tracks these things, an exchange-traded passive fund. What about that one, Tim? Well, Defiance being a good example of what I mean, it does spread the risk, so it allows you to buy into a sort of pool of these things, if you like, but the ETF is still backed by a relatively small number of large names. So the risk is still there. And all those things I said about not understanding what's going on still apply if you're buying a passive product that tracks them. And basically, as far as existing IPO mechanisms are concerned, I can't see any great reason for retail investors to abandon that in preference for these things. These things will say, well, this gives you early access. This gets you in a way that you couldn't with an IPO, because sometimes that's limited to institutions. But actually, I think for most investors, if you want to buy a stock, probably the way to do it is not via one of these special purpose vehicles. It is via a more conventional route. Any questions? editor@killick.com. And if you're thinking, well, what actually is the IPO route, because I'm not too sure about that one that you were talking about, then killick.com/learn. Head for the shares tab and you'll find a video called What is an IPO?